able to make it on. Okay, so we are recording right now. All right, so again, in terms of your question, Caroline, about the stop loss, some persons work with a basic rule of 5 pip stop loss. Some may do a 10 pip stop loss. So different persons have different rules for that. Me personally, I don't like to use stop losses, especially if I'm actually in front of the computer monitoring the trade. I generally would only use a stop loss myself if I'm actually going out or if I have to leave leave the computer, right? Because the stop loss is really there to prevent you from losing money if you're not in a position to stop it yourself. I prefer to just kind of manually observe and watch and see what's going on, and then I would stop it out myself if need be. If I've got a number of trades open, or a number of orders open, then in a case like that, I would probably do it because you can only monitor so many things at a time. It can also have to do with the strategy that you're using as well. If you're doing swing trading, you're looking for big movements, your stop loss might be a bit further back than if you're just doing, scalping and so on. All right. Let me give an example. So here's a trade that I would have entered sometime last week. This is a demo account, as you can see here, demo account. And basically, if I were to put a stop loss on this, as you can see here, I would have entered this trade here. The green line, this green line here represents where I would have entered the trade, and I believe it would have been around this section here. All right. Okay, we got someone's got a lot of wind, on their side. If you can just mute your mics when you come into the room, guys, that'd be pretty awesome. All right, so basically, Caroline, being I would have entered the trade here, if I were to set a stop loss, okay, let me just go ahead and try to mute that individual because I'm getting a lot of noise there. Okay. All right, so guys, you can unmute yourself, but I put everyone on mute, but you can unmute yourself if need be. All right, so just only do that if you really want to say something. So as I was saying, Caroline, if I would enter the trade here, so if I were to put a stop loss, I would generally come back to the 15-minute chart, and look for where I would do that. So let's see, let's look for where I would have entered on this trade. Okay, so here we go. Somewhere up here. All right, right around this point here. So my stop loss based on this, normally what I do when I set my stop losses or my take profit zones, I switch to line view. And what line view does, let me just kind of remove this from here. Okay, what the line view does, it kind of shows me the price points or the most recent price point. So if I entered right here, I would be looking for what point above that was the last point of interest. And I can see right away, if I entered here, I can see that the next point of interest was kind of right up here. All right. I could even do right here. And I look at that because there's a spike right here. There's a spike right, just above here where I would have entered as well. Actually, this green line here, I think the last time I was doing the training, that's why this is here. Okay, because if I entered here, I look back at the last point. Okay, you gotta go back, you gotta look back, and the last point would have been right here. So it tells me that what could have happened would be, if this trade reversed on me, it's likely that it would have gone back up to this point, okay, indicated here by this horizontal line. It would have gone up to this point, and it would have either bounced and come back down, or if it broke through, it most likely would have, that's what you call a breakout, and it would have shot up, all right, to the next point of interest. So if the last point was here and it broke out, it's likely to probably go here. Or if you look here, you see this long movement. You just move this from here. You see this long movement all the way up. The other point that I would have been looking at is probably around here. Okay, that it would have been shooting up too. So based on the length of that movement, I obviously don't want to have a stop loss that far back, because what would be the point of letting, running myself into loss all the way back there? That's actually, if you count that, there's actually about 68 pips, 70 pips. So I definitely don't want to have, a stop loss 70 pips behind. So I would have just pretty much put it, if I entered here, I would have put it right here. And as you can see, that is just about That's just about 9 pips, right? 9, 10 pips. So it's a lot smaller than 70 pips. So that's what I do. I change it to line view, and line view gives me an idea as to where the next price points were, or the last price points were, and that is where I look to set my stop loss. All right. Let me just check the chat. I know you're talking to me in the. Okay. Oh, that was not you. Right. Now another thing that I do as well is based on the strategy that you're working with. So for example, if you're working with the crossover strategy, okay, which is, you've got, okay, we're on the 15 minute right now. You've got the 14 moving average here, which is indicated by the red line. You've got the 50 moving average indicated by the blue line, and then you've got the 200 moving average acting as a resistance, which is the yellow line. So, again, if you remember the strategy, you get the crossover, which happened right here. It crossover went up, then it crossover and went down. Obviously, it pushed down because we've got that resistance from the 200 moving average. You've got the wicks, which tell you that there's price exhaustion above there. And of course, 200 acts as true resistance. So even though they cross the 200 mark, only the wicks cross, not the actual body of the candle. The actual body of the candle closed below the 200 mark. So you already know if you're seeing that kind of movement pushing up, but the wicks, only the wicks cross, and then you see it happen again, you get that movement pushing you back down, then you know you're looking for a pretty big bear movement going down. And so said, so done, as you can see all the way down here. So what happened would have been if I entered at the beginning of this, if I was watching this, you got the cross, you've got the down movement, okay? You would have entered, at the retracement, okay? I would have went through that with you guys before in the other trainings. You got the retracement, which is right here, right? Push down, then the retracement back up as close as possible to the 14. And on the close of this candle is where you would have entered. So let me show you something. If I would have entered here, okay, this line right here, because remember you enter a sell on the close of a buy, and of course inversely you enter a buy on the close of a sell. So you've got the push down, you've got the retracement back close to the 14, and at the close of the buy candle you enter. Now stop loss could have been put anywhere around here, just above the cross of itself. Now there's kind of an unspoken rule where you try not to go past 10 pips. So this one right here is like 25 pips. So this probably would have been a good trade to enter at that point. Now, yes, you could have entered, you would have made some money, but generally you want to have at least a 10 pip, no more than 10 pip stop loss. But this is just to give you an idea as to how that would work. In my case, where I would have entered, and again, this is just a demo, so a lot of different stuff happened. I would have entered up here, all right? If I were to put a stop loss on this, because I can see that there's a major movement or a major gap. See all this empty free space? Let me just put that back to line view. You see all of this? Let me just get my crosshairs. All of this movement here, because there's nothing major that happened in here. It's just a big drop. So because of all this movement, I would know that if this thing reversed and it broke this point here, I would expect that it's probably going to shoot right back up to the last price point of interest. So I would have a tight stop loss on this one, which is what I would have done here. This green line here. Let me just change that. Okay, so this yellow line here is most likely where I would have put my stop loss, because I'm just looking at if it breaks that price point, it's probably going to reverse and shoot all the way up. All right. So I hope that answers your question, Caroline. You can let me know if it did. All right. Any other questions from anyone? Anything that you guys need me to zone in on specifically? Again, I really don't want to be too long and drawn out, so I just kind of really want to zone in on the things that matter to you guys, the things that that you maybe have some problems or some trouble with in your trading. You can use your mic, you can text it, you can even message me on Telegram if you want to. That's not a problem. All right, so while you guys will be thinking about your questions, one of the things that I personally do when I'm trading is, obviously, you're looking for big pips. But I will tell you guys, always remember, risk management is key. And if you start to overtrade and over leverage your account, you're gonna run yourself into some problems. Because yeah, I know sometimes you're looking at the 0.01 or the 0.02 and you're like, oh man, this is pretty small. I want to see some bigger money. But that's all fine and good when it's going good and you're making some profits. But the day that it turns on you and you get hit, you're gonna get hit hard. So you've got to still remember, take it in stages. This is not something to be rushed. I've lost a lot of money before because of over leveraging, and I learned my lesson the hard way. I've lost thousands of dollars in single trades before. So like I said, the market will beat you up and it will teach you a lesson. And a lot of top traders have gone through that. So you gotta learn to actually discipline yourself to keep within what your account actually can manage, and work with that. This is not a get rich quick scheme. This is not something that you're going to get into and just make tens of thousands of dollars in no time. You gotta actually have a formula, and you gotta take your time and do it. All right. Now, one of the things that I do that has allowed me to increase my pick gains is, even though this particular strategy that I just spoke about, which is the crossover strategy and so on. Okay, yeah, which is the crossover strategy and so on. I've actually kind of tweaked that up, and I started to work that with the H1 and the H4 charts. And the reason for that is, obviously, if you do switch to the H1 and the H4, you've got bigger movements that you can see. And one of the things about getting bigger pictures is just kind of taking a step back and looking at the bigger picture. Whether you use the the magnifying glass and you zoom out, if you're on the M15, 15-minute chart, you zoom out, you see what you can see. You can see those movements and patterns. For example, as I zoom right out, what's one of the first things that you guys notice about this particular pattern? Anyone? What's the first thing that jumps out at you right here, right now, that is telling you or giving you an idea as to the direction of this particular pair? Anyone? Use your mic or type it. It doesn't really matter. Let me see if you guys been paying attention to the other trainings that we've had so far, because there's a lot of information in those trainings, man. What is one of the first things that jumps out at you? That tells you the direction that this pair is looking to head in? All right, you guys are taking long, so I'll tell you. But if you look at the chart, can you see the M? Can you see the M pattern? Okay, so Luke just messaged it. All right, there's a huge M pattern right here. Okay, there's also some M and there's some M's and there's some W's in there as well. Okay, if you look right here, there's a W right here. Check it. Just came down, up, down, and check the big movement. All right, on that W. If you mark that from there, that's what 219 pips. 219 pips. Check this big, massive M movement. Okay, there's another W here as well. Actually, if you check it here, if it's switched to line view, all right, it may look kind of messed up, but when you look at the overall big picture, down, up, down, and then major movement all the way up. And if you count those pips all the way up from true support all the way up, it's 560 pips. Now, had you held that trade, and here's the thing, that was like the 13th to probably about the 24th or so. All right, 24th, 25th. Let's see here. Yeah, till about the 25th or so. So this is obviously holding it over a couple of days. So nothing is wrong with holding a trade over a couple of days as well. As you can see here, if you're looking at major movements, all right, huge pips, 560 pips could be life changing. All right, and of course you got the big aim, up, down, M's and W's. Just look for the M's and the W's, and it will give you a very good idea as to what's about to happen, or what can potentially happen in that trade. Another thing that you want to pay attention to, guys, is the retracements. A lot of folks get tricked with the retracements a lot. Okay, retracements is something you gotta expect. Okay, if you're in a trade and the trade is going in any particular direction, you gotta expect that there's gonna be retracement. There's always retracement. For example, now I would have shown you guys already. You've got the 200 moving average, which acts as true support or true resistance based on where it is. And here it is. It cuts right through the candles, and the candles are above it. So obviously it's acting as support here, but it cuts right through, and all of a sudden now support becomes resistance. Now here's the thing: if you check this particular movement from here to here, there's about 170 pips. Now you might say, well, okay, great. You know, you're looking at this is happening, this is moving down. You're like, great. You happen to pay attention to it probably somewhere down here, and you decide, well, let me kind of jump in this thing because you're thinking it's going to tank. But then when you get in, this happens, and you get this big green candle that pushes right back up. So now you're scared, you get nervous, and you're like, oh my god, I jumped to this thing at the wrong time. I'm going to bail. So you're probably, let me see if you're, how much pips is that alone? That's about 61 pips. Just call it 60 pips for now. So, 60 pips in, or 60 pips deep in loss, potential loss, and let's say that you're on a 0.05 lot size right now. Okay, so that puts you about $30 in loss. So you're thinking to yourself, well, shoot, I jumped in around here, all right, and here it is. I've got this massive retracement. Let me jump out. No, you just basically gave the market $30. If your lot size is bigger, like a lot more. All right. But here's the thing. This is why it's important to pay attention to the actual moving averages if you're using that strategy. It did come up to the 14, but did it actually break the 14 and close above it? No, it did not. It came up to the 14, it touched it, it retraced. Okay. It touched it and it pushed back down. It just tested it. It did not close above the 14. And so here's what, if you were looking for another entry to buy in, right? Because I get this question a lot of, if I place a signal, all right, I know, Luco, you asked me this one. If I place a signal in the room, but you didn't catch that signal in time, should you just jump in, or what should I do? Is there a period of time that it's too late to still catch that signal? What are some of the things that you look for? Well, two things. One, if you know where the take profit zone is, and that will always come, or normally comes with the signal itself, you can see how far away you are from your take profit zone, and if there's quite a distance, then you know there's still a lot of movement you can capture. But the question is, do you just jump in? Well, no, you don't. And the reason you don't jump in is because you want to buy wholesale. You don't want to buy retail. So if you're looking at this movement right here and this particular zone right here, so you've seen this downward movement here, and you kind of missed a lot. Then you've got this retracement. If you missed it, guys, don't just jump in. It's really dangerous to just jump into a trade midway, because you don't know what's going to happen. All right. Sometimes things just happen that causes the trade to reverse. What you want to do, though, is you want to wait for this retracement back to the 14 moving average. All right. After that retracement, what do? Again, you sell. Obviously, we can see this is a sell. You sell on the close of a buy. So when this candle here closes, this is when you're looking to buy in right here, at the beginning or at the ending of the buy candle. So you're selling on a blue and on a green, and you're buying on a red. I hope that makes sense. So you get in here, okay, and as you can see what's happening here, you got some lateral movement here though, breaking above. Now here's the thing. Again, I'm just showing you an example of where you would buy. In this particular instance here, one of the things that I tend to start to look at is, if you're watching these lines and you're working with the moving averages, you kind of watch the direction that the lines are aiming in. Because if you see a line like kind of pushing away, like kind of spreading out, and the gap getting wider, then that's a good indication that it's going to push in that particular direction for a bit. If you see that the lines are starting to bend, and come closer and cross, as you can see, the blue is coming down, the red is bending and coming here. That's telling me that instead of the red pushing further down, it's actually kind of getting closer to the blue. So I personally would be kind of cautious as to getting in right here. I'm just telling you guys what are some of the things that I look for, okay? I would be kind of cautious to getting in anywhere here, even though, yes, we did push down, we did get the retracement, and this will be the optimal buying position. At the same time, look at all the other things as well. The lines are bending, which means these are getting closer. Now, if these are getting closer, it means that they could be going towards what? Crossing again, which means direction could be changing. Now, it may not be, but the question is, do you really want to take that chance? I don't think you do. So we have some lateral movement here. The thing is, even if you did buy in, yeah, we had some upward, downward movement, and it did push down eventually. All right, it did push down, and you've got a lot of big movements here, and it continued to push down. So getting in here, but look at what's happening all across here. All right, all across here, you've got some major movements that even if you had a stop loss, a tight stop loss, you know, you might have got stopped out perhaps, depending on where you put it. So you just want to watch these things, guys. You want to watch the lines carefully. Let's go a bit further back and give you some better examples. Okay, let's look for another cross. Okay, so oops, okay, so we got a cross down here. So again, true support, true resistance. Spoke about that. Okay, one thing that you always want to pay attention to is, are you trading the bounces off true support or true resistance? Sometimes folks just want to jump into stuff because it looks like it might go up or it looks like it may go down. That's really a bad way to trade. You can lose money very quickly if you trade in that way. What you want to identify is your true support. All right, what's the lowest point that's being achieved or touched in that area of data that you're looking at? And true resistance, if it's above, of course, support being below, resistance being above. These are the things that you really want to pay. You definitely want to pay some serious attention to. So here it is. You've got this trade. We've come down, and down here, all right, I've even got it marked out already. So because I was looking to see, okay, where's my true support? Now we've got a cross right there. We got a almost cross right there, almost cross right there. But it came and it pushed and it did what it had to do until it reached this section down here, all the way down. This now became my true support. So once I've identified that, it tells me that the bounce that's going to come after true support is going to be an upward, obviously an upward movement. And so said, so done. It bounced up, it crossed. You see the upward movement here. So the question is here. It crossed here. Where do you buy in? Where do you buy in? Do you buy in on this green candle? No, you don't. Okay? No, you don't. Do you buy in on this red candle? No, you don't. You're going to buy in on the retracement that gets as close as possible to the 14 moving average. So it went up. We got the VIX. The 200 moving average pushed it back down a bit. Don't forget, moving out, this acts as resistance or support. So it pushed up. It didn't keep pushing up because we've got the 200 moving average. It pushed back down and tested the 14 though. So look at the confirmation. So you've got true support below, you've got the 14 below the candles, and you've got the 50 below the candle. So here's the thing: even though you've got the 50, the 200, which acts as resistance, that's one guy. But you've got true support, 14 moving average, and 50 moving average. You got 3 against 1. So it's telling me that there's a strong push to the upside. So here's what happens: it pushes up, and it pushes right back down. Again, the green candle, all right, it comes right down, breaks the 14, but it does not close below the 14. You see that? So this is what you call the low of the day. The low of the day represents, the lowest point that, that candle has reached for the, for the day. All right. Or what just happened there? Oh, market just opened. Okay, market just opened. All right. So let me just kind of skip right over to that section. Let me just take this and this off and find back that point. Where were we? Okay, here we were. So it went up, it retraced, it broke the 14, but the body of the candle closed above the 14 moving average. So remember what you do. You don't buy on a buy, or you don't sell on a sell. You buy on the close of a sell, and you sell on the close of a buy. So came down. All right. Here's the sell candle retracing close to the 14. At the close of this candle is when you could have bought in. All right, right here on the close of this sell candle, because you're looking for a buy. So you buy in on the close of the sell, which should be on this candle here. So if you did that, you followed that simple rule. Actually, it's really simple. You bought in here, all right? Open here, and you let it ride. You got some ups, you got some downs, but look at this movement. Now you could have done one or two things. You could have said, well, okay, I'm going to close when a sell candle breaks the 14. Now it did break the 14 right here, so you might have closed here. Wouldn't have been much pips, but let's see. You got a cross, you got a retracement, you got your buy. you entered here, all right? And the only point in time where the 14 was broken was right here, the first time. You see what happened? 38 pips, you would have still reached on that. Now, some persons, they actually follow along with the 50, which is the blue line, versus the 14. Okay, so if you're looking for a break on the 50, well, none hasn't happened for a while. We got one here, but that was just a wick. So check if you follow the 50 all the way up. We're already at 448 pips, guys. Let me see if I can get a bit further. Okay, here we go. So if you just follow that one rule, check this out. Retracement, okay? Retracement, and you bought on the close of the sell. And you rode it all the way up. And if you're looking to jump out this trade when it broke the 50, well, look, it broke the 50 right here. It broke and closed below the 50 for 438 pips on this one trade. Now, yes, it would have run you a couple of days. It would have run you a couple of days. That was actually running from the 13th to the 27th. So you would have been holding that for a couple of days, but think about the amount of pips you could have received on that. Actually, if you only had a, let's say, 0.05, all right, and we said 430 pips, okay, so we multiply that by 4,300 points, okay, since we work in pipettes, $215 US on just 0.05, all right, so not even 0.1, just just half of that, and you would have knocked off 215 bucks on that. Bigger lot size, a lot more money. Okay, so so that's just one of the things that you can look at. Let's look at it again. All right. So we got it here again. We got the cross. We got the drop. You don't buy in just like that. You wait for the retracement. Okay. It pushed back up. Push back up. This isn't as close as I would ideally like to see. I like to see it a lot closer. But just so you guys understand, you know, you're still buying on that retracement. It comes back up, gives us a wick there. Then you sell on the close of the buy, okay, and you get in there, and you just rode that baby all the way down. We got a wick, not the actual candle, so we would have stayed in that trade, and you rode it as far down until the green candle broke the 14, which is right here. So you rode that all the way down. That's 177 pips. Just like that. Your stop loss, again, you're buying on the retracement, your stop loss could be just above the actual cross itself. So anywhere around here, okay? Anywhere around here, you could have had your stop loss. So your stop loss would have actually been 17, just really crosses. Oh, sorry, not really crosses, because you would have bought in right here. Oh, well, this is still H1. My apologies, guys. This should be done on the 15-minute, because you definitely don't want a 70 pip stop loss. But just still, you know, the principle remains in terms of, you know, how you would look at it and where you would buy in. You don't want to stop loss that big, but you would pretty much do that on the 15-minute chart, and that's where you set your stop loss. So, for example, we cross here, pushed up, retracement back down to the 14, okay? And then you do what? You buy on the close of a sell. So this guy would have closed here. All right, and it went up, came back down, and this is where the 14 was broken. So 57 pips is your profit. Your stop loss in this scenario, just below the cross. So the cross happened here. Probably even put it right there. All right. So your risk, 17 pips. Your profit, 57 pips. All right, 55 pips or so. Does this make sense so far, guys? Any questions, any queries, anything that oh, and it's 5 o'clock already. Any questions, any queries that you may have, please make sure you ask your questions, because it doesn't really make sense to be here not asking any questions, being quiet, and then, you know, asking a million questions afterwards on how to do X, Y, or Z. The reason for these trainings is so that you can understand and so that you can learn. So you want to make sure that you ask your questions here. All right. If there are no questions, I'm just gonna go ahead and close. I hope that you guys understand a bit more about the strategy. Again, like I said, I use that strategy, but what I do, I like to use the H1 and the H4 to get a bigger picture of what's going on. And in terms of setting my take profit zones and setting my stop losses, again, pretty straightforward. What I do, I switch to line view, and I look for the break point. See this? This is a break point. Boom! I go right there. I get a horizontal line and I place it right there. All right. Here's another one. Boom! Place it right there. This, if I bought in below and this was down here and this was going up, you know, but these are points that I'll be looking for if I bought it anywhere around here. I'm looking at these points. These points are important points. All right. Always. And of course, I'm paying attention to the 200 moving average as well, because if that is acting as resistance, I'm expecting for things to push down. If you look at what's happening right now, since the market opened, just before we go ahead and close this off, I think I saw someone message in the chat. Let me see what's being said there real quick. So the cross I'm not sure what you're saying, Matthew. You say so the cross I'm not sure what you mean. Gotta explain that a bit more. All right, so here's something, guys. All right, let me just show you right here. If I'm looking at this right now, okay, as it is, market just open. Of course, you can see what's happening. This is why you don't like to hold trades over the weekend, because check what's going on. When this trade closed, thank God this is a demo account. When this trade closed, it's pushing down, pushing down, pushing down. Market open, look what happened. Boom. See this line? Is facing up now. And it's a huge green candle. So here it is. If I was in this trade live down here, all right, expecting this to push down, market opens and look where it is right now. 32 pips in the opposite direction. Now, that might just be a stop hunt. I would not be surprised that it's a stop hunt. It may push back down. But the thing is, if I had a stop loss anywhere above here, you see this huge wick? That's to stop me out. That's to collect all the stop losses that might have been in those particular areas from people who would have had trades open over the weekend. Anyone who would have had their stop losses put, say, around here, okay, would have just got stopped out. All that money is gone. Brokers just collected that money. Market makers just collected that money. And now it's probably going to push back down. Probably. Why I say probably is because, one, it made a cross here. It's already heading down. So there's a movement to head down. One. Two, 200 moving average is above, which tells me that there's resistance above that wants to push it down. So it's likely it probably still will push down. Three, there's a huge wick. So this huge wick tells me that even though it pushed up, this may just be a stop hunt candle. Well, and four, market just open. That's just what they do when market opens. They try to get all those stop losses that were in place to knock you out, and then probably continue in the same direction. All right. So those are some things you want to look for. Real quick, let me switch this up. You see this kind of movement here? When you see this kind of direct push, like a pin, just pushing. If you notice, it's pushing against the 50 moving average. You guys notice that? It's testing on it. Now, don't forget that the line chart only shows you the body of the candle itself. So even though when I switch, you notice that the wick is all the way up here, I'm not even paying much attention to that. What I'm looking for is the actual candle itself. And you realize that as much as the wick is above, the candle itself is pushing and testing the 50. It's only testing the 50. As much moving around and bouncing up and down is doing, it's not going past that 50 as yet. Now, it may break above the 50, but even if it does, I don't suspect it's going to break and go too high. It probably is going to go up to some point. Might be to this level here. Why? Because this was a price point. This was a price point of interest. A big spike right there. It may go up to this point, touch it, and bounce back down. The most it might do is go up to the 200 and bounce back down. Look at the history. Always pay attention to your history. Cross the 200, back down. Went up, crossed it, nope. Kept under it. Touched it, retested it again, back down. So what it says is that there's a strong resistance coming off of the 200 moving average. All right? See what's happening here? It's pushing up. It's pushing up. Okay? But because of the resistance, probably going to come back down. All right? Also, you got to remember as well, a lot of stuff changes over the weekend. So this is why it's really, really dangerous to hold trades over the weekend, guys. Really, really dangerous. Let me see what's going on in the chat. I just learned that don't leave trades over the weekend. Yeah, definitely. That's true, Malcolm. It's really dangerous, man, because you don't know what's going to happen. Market opens up and massive spikes. Simali says sort of cross indicates a change in direction. If there are two crosses close, which one do you look at? Okay, what I look at is the last one, the one that would have happened last. So you may have sometimes, if you got a cross that happens close to another cross, like in this example here, you see you've got an upward movement, then you've got a downward movement. These are very close. Even if this one didn't, this down arrow here or this cross didn't happen, I still wouldn't have bought into this because the lines are too close. I don't ever buy into trades when the lines are this close together because anything can happen. Let me see if we can find another example of that. Once you get those lines a little too close, okay, here's another one right here. Okay, see this? See this lateral movement here? It's really dangerous to trade at all in any kind of lateral movement. You're looking for ups and downs. You're not looking for sideways. Sideways movements will hurt you unless you're doing scalping. Yeah? So this would have crossed here. Boom. And you look at it and say, okay, good, we got a cross. Nope. You got a cross, but those lines are way too close together. Way too close here as well. Way too close there as well. I wouldn't be trading, period, any of those crosses. Let me show you what you want to look for. Okay, you see this? This is a cross, but if you look at the difference now, there's some distance between the two. Not a big difference because as you realize, it didn't stay that way too long. It pushed up and it came back down. Here's another reason I probably still wouldn't have traded this. The retracement candle, the sell candle, is still too far from the 14 moving average. Don't forget that you always want to make sure that, oops. Okay, oh, there we go. All right, just knocked my screen out. Okay, so you always want to make sure that retracement is as close as possible to your 14 moving average. All right. If it's too far off, then it's best to probably just leave it and just wait for it to come close. Because what can happen is you can buy in here thinking, okay, this is as close as it's going to get, and you buy in and you're looking for it to go up, but then you get another candle that forms and the candle shoots down further, and sometimes even breaks the 14 and probably even breaks the 50, and then you're like, holy shit, I should have waited because now this candle just kind of dropped all the way down here and I'm in a loss. So you want to be mindful of that. You don't just want to see the cross and then just jump. You want to look at the cross, observe the distance between the two lines, give it a little time. Like here, cross, push down, retracement. But look what happened. Retracement broke the 14. So you definitely don't want to get in there. It pushed down again. All right. Retracement again. But look, it broke it again. All right. You don't want to do that. Push down again. Retrace. This time it closed close to the 14. It didn't break it. Boom. So you would have bought in on this buy at the close of this buy candle here. Push down, buy candle, which is the push up. So even though it's a sell, you're buying on the close of this buy candle. When it closes, boom, right here is your entry. Okay? It didn't close below, it closed right here. Right here's your entry, and then just this what? From there, you just ride that baby right down. Boom, 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 all the way down. Retracement again. So this could have been a second entry right here. All right? Came up, close, and then you've got, that buy candle there, and then that could be a second entry for you, okay? And write it right down, right here. 144 pips, all right? Just like that, 144 pips. I have problems knowing when they're, not sure what you're saying there, Malcolm. So you have problems knowing when something, all right? Okay, when the candle closes. Yeah, you see, you just gotta have patience. Because sometimes we want to jump into the candle before it actually closes, right? If you say, okay, it's close, let me just buy it, and that's the problem. You might buy it, and then it continues to push up. If you're looking for a sell, and it continues to push up, and it goes against you, what you gotta do is wait for it to actually close. Don't forget, it's 15 minutes. If you're on a 15-minute chart, you know that every 15 minutes, the candle is gonna close. You could literally go away and do something for 13 minutes and come back, and for the next 2 minutes you just watch it, or 14 minutes to come back, and you've got 1 minute left before that candle closes. It's a 15-minute chart, so you don't have to be there like, okay, I don't want to miss this. If you see a candle open at a particular time, you know that in 15 minutes is when that candle actually closes. It's pretty easy to monitor. You just got to keep track. If you're doing it on a serious level and you're keeping track of these things, then it's really not difficult. You're not going to miss the jump. It's 15 minutes. Come back in 14 minutes. And you just move from there. Right? But you definitely do have to have patience. This is, like I said, it's not a get rich quick scheme, man. You gotta really, really have some patience and let the charts tell you what they're doing. Don't rush it. Don't push it. Don't jump ahead of yourself. Let the candles, let the charts tell you what they want to do. Don't chase the trades. Let the trades come to you. And if you start to do that, you start to let the trades come to you, and instead of trying to rush behind them and kind of jump in at the what you would consider the best moment, you're going to win a lot more trades, and you'll be all right. Yeah. Any more questions? We're about a little longer than I expected to go. You know what? Yeah, guys, I'm gonna just close off at this time. Like I said, I really didn't want this to be a long, drawn out session. So I hope that you guys would have learned a bit. Didn't get much questions, but hey, like I said, this training is for you guys. So if you notice some stuff you want to learn, you need to ask those questions and understand what you're doing. Okay, good stuff. All right, so yeah, again, thanks for coming on, guys. And trading, like I said, the market is open. I most likely won't be trading until London. Trading on Sundays is dangerous because one, it's Asian session, and two, this is stop hunt time. So they're gonna be doing a lot of stop hunting, a lot of just trying to grab your money. So I really don't like to practice trading on Sundays. A setup would have to be extremely good, but even so, I still try to resist it, and I just wait till tomorrow morning. All right, so have a good one, guys, and I'll see you back on the inside. Bye-bye.